Welcome to Walls and Wire. Today, we're talking about Anwar's assurances on Malaysia's external debt. We have to start with the number, the one that, makes everyone just stop and stare. It's this massive headline figure. As of the third quarter of this year, Malaysia's total external debt hit 1.4 trillion ringgit.
It's an immense figure. And when you put it in context, it's about, 69.4% of our gross domestic product?
Exactly.
And if you're just a casual observer or you're looking at other countries that have faced economic trouble, a number that high, almost 70% of GDP, that usually looks like a huge red flag.
It really does. It's a number that screams for context, because if you just stop there, at 1.4 trillion ringgit, you'd naturally assume the worst. Yet you have the Prime Minister and Finance Minister, Datuk Seri Anwar Ibrahim, being, incredibly direct in his assurances. He's on record saying this level of debt is controllable, that it's at a safe level.
And that it won't jeopardize the national economic outlook. That's the key phrase.
Right. So that's the real tension here, isn't it? For anyone listening, when you hear a figure like 1.4 trillion, why should you believe the claim that the risk is minimal? What's the substance behind that confidence?
Well, let's get into that, because the Prime Minister's argument isn't just wishful thinking. It's based on the architecture of the debt itself. He specifically mentioned good debt maturity and currency composition.
Okay, so let's break that down. Let's start with maturity.
Maturity is everything. It's basically asking, when does the bill come due? If all 1.4 trillion had to be paid back next Tuesday, we'd be in a catastrophic crisis.
Of course, that's what analysts call refinancing risk, right? The danger you can't roll over the debt.
Precisely. It's the difference between your mortgage spread over 30 years and a massive credit card bill that's due at the end of the month.
A very good analogy.
And this is where the first part of the stability argument comes in. As of the third quarter, 56.9%. So well over half of that external debt is classified as medium to long term.
So more than half of it isn't due anytime soon.
Exactly. The burden is staggered. It's pushed out far into the future, which drastically lowers that immediate pressure. That refinancing risk we talked about is significantly reduced because of that structure.
Okay, so the timing makes sense. But what about the cost? Timing is one thing. But if a big currency swing suddenly doubles or triples what we owe, that brings us to currency composition. That feels like the really dangerous part of external debt.
It is. It's often the trigger for a full-blown crisis. If you owe a fortune in US dollars and your local currency, the ringgit, suddenly weakens, you're in a terrible trap. You have to find so many more ringgit just to make the same payment.
So how are we protected from that?
This is where the structure is, I think, quite clever. Malaysia has built a pretty significant firewall here. The federal government's direct external debt, the part most sensitive to these currency swings, is it's actually tiny.
How tiny are we talking?
We're talking less than 3% of all the foreign currency-denominated external debt.
Wait, less than 3%? That number really needs to sink in.
It does.
Because I think most people hear external debt, and they just assume it's all owed in dollars or euros and is a ticking time bomb if the ringgit moves. But you're saying the vast majority of that 1.4 trillion is actually denominated in ringgit.
That's the key. That's the structural defense. Because most of it is in ringgit, a weaker currency might make imports more expensive, yes, but it doesn't suddenly inflate the principal of our external debt. Your debt balance stays the same, which is a huge stabilizing factor.
So the risk is hedged internally. And the PM wasn't just making this up. He was actually referencing international standards, the kind of criteria that organizations like the International Monetary Fund use.
He was. He pointed out that serious debt risk usually comes with a combination of three things: a lot of short-term debt, high exposure to foreign currency loans, and a current account that's consistently in deficit.
And his point was?
His point was unequivocal. Those risk factors are just not present in Malaysia's current situation.
Okay, so the structure is sound. The hedges are in place. Let's move to the ultimate safety net then, the actual cash on hand, the national reserves at Bank Negara Malaysia.
The war chest, as it's sometimes called. The central bank's ability to step in and keep things orderly.
And the number there are pretty huge too. As of October 31st, the international reserves were US $123.8 billion.
Which is about 521.6 billion ringgit. It's a colossal amount of liquid capital.
And it's more than enough, I assume.
Oh, yes. It's comfortably above the standard international benchmark, which is holding enough to cover 3 months of imports. But to really pressure test it against that 1.4 trillion figure, we need to look a bit deeper.
So what do the more rigorous metrics tell us?
Well, if you compare the reserves to our short-term external debt, The stuff due soon. Our reserves cover about 0.9 times that value, so nearly one-to-one coverage.
That's quite solid.
It is. But the real confidence booster is when you use the International Monetary Fund's more comprehensive framework. It's called the Reserve Adequacy Assessment Indicator.
And according to that,
According to that indicator, our reserves are maintained at a 104% adequate level.
104%. So we're not just adequate, we're actually above the optimal level defined by the IMF.
That 4% buffer might not sound like much, but in global finance, it's a very strong signal. It means we have more than enough to handle our immediate obligations, even with some market volatility.
But the PM said something interesting. He said the reserves at Bank Negara Malaysia are not the only tool we have.
And that is a critical point. It's a nuance that's often missed in the public discussion.
So if the central bank's reserves aren't the only line of defense, what is? Where does this other strength come from?
It comes from the private sector, from our large Malaysian companies, our banks, our financial institutions that operate globally.
Okay, how does that work?
Over the years, because of a deliberate liberalization of foreign exchange policy, these private entities have been able to build up and hold a really large amount of their own external assets held in foreign currencies.
So the government effectively decentralized the country's financial buffer. Instead of keeping all the US dollars locked in one vault at the central bank, they let the market itself build up its own savings accounts.
That's a great way to put it. And it acts as a massive shock absorber. If a crisis hits and a big company needs to pay an import bill or settle a foreign loan, they don't all have to rush to Bank Negara Malaysia for dollars. They have their own operational pools of foreign currency.
That seems like very smart planning. It moves some of the burden off the government's balance sheet and onto the private sector, which gives you like 2 layers of defense.
It's a core pillar of our external resilience, and we can see this in the numbers. It's verifiable in what's called the net external asset position.
And what does that tell us?
It tells you if, as a country, you're a net borrower from the world or a net creditor to the world. And at the end of Q3 this year, Malaysia recorded a net external asset position of 77.3 billion ringgit.
So to be clear, that means after you add up everything Malaysians own, overseas investments, property, cash, and you subtract everything we owe to foreigners.
Yep.
We're still 77.3 billion ringgit to the good.
Correct. We are a net creditor nation. That position, which is about 3.9% of GDP, is a concrete sign of financial strength. It shows that collectively, the country has a lot of wealth abroad that can be brought home if needed.
Which is why the Prime Minister can say with confidence that the country has a strong capacity to meet its external obligations.
Exactly. The international reserves are there for Bank Negara Malaysia to manage the currency market, but the private sector has its own substantial buffer.
So to sum it all up, that 1.4 trillion ringgit number, it's a scary headline. But when you look under the hood, the debt is mostly in ringgit, the repayment schedule is stretched out long-term, and our cash reserves, both public and private, are well above international standards.
It moves the conversation from the raw size of the debt to the actual quality of the debt. And the quality is high because the risk has been very deliberately managed.
That definitely provides a much clearer picture. So let's leave our listeners with a final thought to chew on. We've laid out how the debt structure is built to withstand shocks.
It's designed for resilience.
But no system is perfect.
Yep.
So here's the question. Considering this detailed structure, the currency hedges, the long maturity dates, what specific short-term global event do you think would be the most likely to really test this claim of resilience? What could happen that forces us to actually use those private and public buffers?
That's the billion-dollar question, isn't it? The system is strong, but the world can be unpredictable. Where would the real stress test come from?
Remember to like and subscribe for more videos like this.